Welcome back to the Deep Dive. Today we are taking a sledgehammer to one of the most debated, richly valued, and I think critical companies in tech right now, Snowflake Inc., ticker SNOW.
Yep. And we're anchoring this analysis specifically to December 4, 2025. The stock closed at $265, which gives it a market cap just a little north of $90 billion.
And that $90 billion number is so important, isn't it? It tells you this is, it's way beyond the speculative phase.
Oh, for sure. But it's still small enough, compared to the trillion-dollar giants that it could have some serious upside.
So our mission today, based on everything we've dug into, is to figure out if Snowflake can really pull off this pivot. I mean, can they go from being the world's best data repository
To becoming the high-octane intelligence engine that you need for this global AI arms race. That's the whole game.
That's the tension. Exactly. Can they go from being a passive vault, even a really secure one, to being the active core, where all the next-gen enterprise AI gets built? Everything we've read suggests this whole deep dive comes down to a high-stakes bet.
A bet on execution. And it's set against this backdrop of, hyper-aggressive competition and a macro environment that is genuinely pretty toxic.
And we're not going to make you wait until the end for the punchline here. We've stress-tested the valuation, run the models.
We have. And our intrinsic value calculation, it suggests that at 265, the market has this price pretty efficiently. It's baked in the growth, but it's also baked in the very real risks we're going to talk about.
So the question isn't, is Snowflake a good company?
No, it undeniably is. The real question for you, if you're holding it or thinking about it, is are you willing to make a high-conviction bet on the new CEO, Sridhar Ramaswamy? Is this a screaming bargain? Or is it priced for perfection? Our numbers lean heavily towards perfection.
To give you that full picture, we're doing a full breakdown. We'll get into their revolutionary business model, scrutinize that massive leadership change, stress test the financials.
And we have to talk about the external risks, especially those 2025 tariffs and how they ripple through IT budgets. We're here to give you the shortcut to understanding why this data giant is exactly where it is today.
Part 1. Chapters 1 to 3, business, management, and financials.
All right, let's dive in.
Chapter 1, business understanding.
Okay. To really get Snowflake, you have to start with the fundamental shift they pioneered. The analysis calls it the consumption paradox. It's the core of their model, and it really does break all the old rules.
It does. I mean, for decades, you had companies like Salesforce or Adobe on these predictable SaaS subscriptions. You paid your money per user, per month.
Right, and it didn't matter if they logged in once or 100 times. Snowflake they rejected that completely. Their entire revenue stream is variable. It's based on how much compute a customer actually uses.
It's the electricity bill analogy. That's the famous one.
Yeah.
You don't pay a flat fee. You pay for the kilowatts you actually burn.
Exactly. Snowflake customers pre-buy these things called credits, and those credits get used up whenever they spin up a virtual warehouse to run queries or now to train AI models.
And that's the paradox, right? The double-edged sword.
It is. The upside is magnificent for growth. It's a frictionless expansion engine. If a big retailer suddenly needs 5 times the compute for a new project, they just flip a switch.
And boom, Snowflake's revenue goes up.
Yeah.
No new contract, no long sales cycle.
None of that. Their success is perfectly aligned with the customer's success. But the downside is it's terrifying for forecasting.
The volatility is just extreme. If a CFO mandates a 20% cut in cloud spending, which happened everywhere in 2023.
The engineers can literally turn off the lights. They optimize queries, run fewer reports, and the financial hit to Snowflake is immediate and steep. Wall Street has a really hard time modeling their quarters because of this.
And when you look at the numbers, that consumption revenue is everything. It's what, 96, 97% of their top line?
Overwhelmingly. It's all product revenue, compute, storage, data transfer. The other 3 or 4% is professional services, which is low margin.
And that piece is purely strategic, right? They're not trying to become a consulting firm.
Absolutely not. They often offer those services at cost just to get a customer migrated faster. The goal is simple. The quicker we get your data into our cloud, the quicker you start burning those high margin credits. It's an investment, not a profit center.
Okay, so let's talk product evolution, because that's the AI story. They're trying to move from being the data cloud to the intelligence engine. The foundation was the data cloud itself.
Right, the idea of pulling in all these disparate data silos from SAP, Salesforce, AWS logs, you name it, and putting it all in one secure place, a single source of truth.
But the critical step that really unlocked the AI potential was Snowpark.
Yes. Historically, databases were built for SQL, which is great for analysts, but not so great for modern machine learning, which runs on Python or Java or Scala.
And the old way of doing this was so painful, you'd have to pull petabytes of sensitive data out of the secure database and move it somewhere else to train your model. It was an ETL nightmare and a governance disaster.
Snowpark just flips that on its head. It lets developers bring their code, their Python algorithms, and run it securely inside Snowflake's perimeter, right next to the data. No more moving massive data sets around.
Which is a game changer for any company dealing with strict regulations like high pay or GDPR.
It's a fundamental architectural advantage, and that leads you directly to the AI layer they're building in 2025, Snowflake Cortex and Snowflake Intelligence.
Cortex is the infrastructure piece, right? The managed LLMs, the vector search.
Correct. But Snowflake Intelligence is the big conceptual leap. This is where they're offering AI agents that can execute complex tasks based on business intent, not just code.
We should probably define what they're really trying to be here. They're positioning themselves as the enterprise R engine.
Retrieval augmented generation. It's a critical concept. A generic LLM, like GPT-4, is powerful, but it hallucinates. It makes things up because it doesn't have your company's specific context.
So RE fixes that by first retrieving verified proprietary information from your company's secure data,
Which lives in Snowflake.
and then feeding that context to the LLM to generate an answer. So Snowflake's bet is that the quality and security of that retrieved context is actually more important than the generic model itself.
Exactly. Their strategy is, we hold the secure context, so we will host the RAG engine.
And all of this feeds the network effect from the Snowflake marketplace. I mean, it's basically an app store, but for data.
It really is.
Yeah.
A company can just subscribe to real-time shipping data or weather data instantly. And crucially, the data is shared without ever making a copy. That's the magic.
Being able to share massive data sets instantly and securely without copying is what locks in these huge enterprises. It's what creates that data gravity.
Absolutely. The more valuable data that lives in Snowflake, the more everyone else wants to be there to access it.
And they are not dabbling here in terms of scale. They're at, what, over 12,000 customers total.
12,621. But more importantly, they've captured the big fish. 766 of the Forbes Global 2000. These are the stickiest, highest spending clients you can get.
And you can see that in the whales metric, the customers spending over $1 million a year.
That number is up to 688, and it's growing at 29% year over year. That's the best proof of deep integration. It shows these companies are running mission-critical systems on Snowflake.
The core value prop that got them here was that elegant idea of separating compute from storage.
Right. Old databases bundled them together. You had to buy a massive server. Snowflake broke them apart. You store the data cheaply, and you only pay for the expensive compute when you need it.
That elasticity solves so many old IT problems, like the Monday morning problem where the system crashes when everyone logs on.
And it lets you scale up instantly for big jobs like quarter-end reporting, and then scale right back down to zero. It's all about efficiency and infinite scale.
But that flexibility and premium price tag is exactly why the competitive landscape is, well, a war zone.
It's a total frenemy ecosystem. They pay billions to AWS, Azure, and Google for infrastructure.
While competing directly with those companies' own products like Redshift and BigQuery.
But the real head-to-head battle, the one that dominates the entire narrative, is Databricks.
It's a war of conversions, right? Databricks started with the coders, the data scientists built around open source. Snowflake started with the analysts and SQL.
And now they're both racing to the middle, trying to own this unified lakehouse architecture.
But the private market is sending a really worrying signal here. Databricks' latest private valuation was over $100 billion.
$100 billion, which actually surpassed Snowflake's $90 billion public market cap. That's a huge challenging data point.
What's the signal there? What are private investors saying?
They're signaling that they believe Databricks' AI-native DNA, its roots in open source, might have a long-term advantage in the generative AI era over Snowflake's more proprietary SQL-native architecture. The implication is that Snowflake is playing defense.
And can't forget Palantir, PLTR. They're coming at this from a different angle, selling actual AI applications with their AIP platform.
And growing fast. Their commercial revenue is up 44% in the first half of 2025. That significantly outpaces Snowflake's current growth rate. Palantir is much more application-centric.
Interestingly, you argue that regulation is actually a moat for Snowflake, especially in Europe.
It is. GDPR, the EU AI Act, they demand strict data sovereignty. Snowflake's cross-cloud grid is a brilliant solution for that. An analyst in New York can query data that has to stay in Germany without ever moving the files across the border.
That's compliance as a service. It locks in the biggest global companies.
It's a huge advantage. Let's talk a bit more about what justifies that 20x sales valuation, though. Beyond the data gravity,
Well, there's the trust barrier.
astronomical. It's one thing to build a simple database. It's another to get FedRAMP High, HiPi, and PCI DSS certified globally. That's a decade-long exercise in security audits, and Snowflake has that head start.
And they have a cool brand. In enterprise IT, that's rare. Developers actually want to work for them and use their product.
Which helps them attract top-tier AI talent. That's a massive advantage. Then you have their structural cost advantages.
The volume discounts.
Exactly. They are one of the biggest customers for AWS and Azure. They buy compute wholesale, package it with their software, and sell it at a premium. That margin funds their entire R&D budget.
But the single most powerful advantage has to be the switching costs, the gravity.
It's immense. If you have 10 petabytes of data and 50,000 queries running your business, migrating off Snowflake isn't a project. It's a multi-year, multi-million-dollar nightmare. That's why their retention is so high.
And finally, there's that unique asset they got from the Neeva acquisition.
The search technology. The new CEO, Sridhar Ramaswamy, founded Neeva. By buying it, Snowflake got a native high-performance search and retrieval capability, the R in RA, built right into their core architecture. That's a huge technical leg up. Chapter 2, Management Evaluation.
Now we have to talk about the management team, which saw, probably the most significant leadership change in enterprise software in 2025.
The pivot from Frank Slootman to Sridhar Ramaswamy, this was so much more than a new CEO. It was a change in the company's DNA.
Slootman was the legend, the wartime general, famous for just relentless sales execution. He was patent.
Brilliant at execution, conquering market share. Ramaswamy is the opposite. He's the engineer's engineer, the product guy who scaled Google's ad business from $1.5 billion to over $100 billion. He's Oppenheimer.
The signal from the board couldn't be clearer.
It's crystal clear. The land grab phase is over. To win the AI war, you don't need a sales executioner. You need a product visionary. They are explicitly pivoting from selling the data cloud to building the AI operating system.
And Ramaswamy has already been tested. There was that governance hiccup in late 2025.
The social media incident. An executive made some unauthorized comments on the School of Hard Knocks account.
And the stock wobbled immediately.
It did. But Ramaswamy's response was swift and disciplined. They immediately filed an 8K with the SEC to clarify and reaffirm guidance. It showed a zero-tolerance policy for miscommunication, which is exactly what you need to maintain investor trust.
Ethically, they're still pushing that neutral Switzerland position.
Which is a core advantage. They promise you security without the vendor lock-in you get from the hyperscalers.
Let's talk capital allocation. The M&A strategy's really shifted.
It has. They've moved from small tuck-ins to buying strategic capabilities. You saw it with Neeva for search, Streamlit for building apps, Crunchy Data for Postgres integration, and Samuha for clean rooms. They're buying time and talent to stay ahead of Databricks.
And that requires a massive R&D budget.
Massive. $494 million in Q3 alone. That's 41% of their revenue. It's non-negotiable. They're in an arms race with Databricks and the hyperscalers. That 41% tells you how urgent this AI pivot is.
Now, for shareholder returns, no dividend. Obviously, they're a growth company.
Yeah.
But we have to look at the share repurchase program.
They've spent about $485 million year-to-date on buybacks, which sounds good, but it leads you right into the dilution problem.
Because even with that nearly $500 million spend, the share count is still creeping up.
It's still expected to hit $377 million in Q4. So you're spending all that money just to stand still or even lose a little ground on share count.
Doesn't that sort of undermine the value creation story? It feels like they're just subsidizing the stock-based comp for their engineers.
It's a very fair criticism that money is essentially an operating cost to keep the talent. The problem is, stock-based compensation, or SBC, is a critical hiring tool in AI. But for you as a shareholder, it means you have to factor in a persistent 2 to 3% annual dilution. The growth has to outrun it.
But they're generating serious cash. The adjusted free cash flow was $136 million in Q3.
Over $410 million year to date. And this is the key counterargument. They can fund that massive R&D, run the business, spend $500 million on buybacks, and still generate hundreds of millions in real cash flow. That shows a maturing, operationally strong company.
Chapter 3, Financial Health.
All right, the numbers. Starting with the market cap, $90.1 billion. At that size, they're under a microscope. Too big to be a speculative darling, but their whole valuation depends on sustaining premium growth.
And that's where the law of large numbers comes in. The triple-digit growth days of 2021 are long gone. The cloud optimization headwinds slowed them down.
Now they've stabilized. Q3 product revenue was $1.16 billion, up 29%. For a company this size, that is elite growth. The new goal isn't getting back to 50%. It's proving they can deliver durable 25 to 30% growth at scale.
Okay, profit margins. This is where it gets complicated. It's like looking at two different companies.
Let's start with the spectacular part, gross margin. Non-GAAP product gross margin is 76%.
76%. That is absolutely elite software territory. It's proof of their pricing power, even after paying billions to the cloud providers.
Now for the SBC divide. The GAAP operating margin is a deeply unprofitable negative 27%. They are losing money, according to standard accounting.
And the only reason for that massive loss is the $442 million in quarterly stock-based comp.
Exactly. So if you strip that non-cash expense out, the non-GAAP operating margin is a healthy, profitable 11%.
But is that non-GAAP figure misleading? I mean, are we just sweeping a huge real cost under the rug? Shareholders are being diluted to cover that expense?
That is the critical lens you have to use. The non-GAAP number tells you the core business, if paid for in cash, is profitable. But since that SBC converts to real shares, it is a very real cost to you, the shareholder. You have to weigh the high margin against the high dilution. It's a trade-off.
Moving to financial stability, though, their balance sheet is a fortress.
It is. They have about $3.35 billion in cash and investments against $2.28 billion in convertible debt. So about $1 billion in net cash. That's a war chest for R&D and M&A.
And that $2.42 billion in deferred revenue, while it's a liability on the books, it's basically future revenue they've already collected.
Right. It's a great sign of future consistency. Okay, valuation. PE is useless since GAAP earnings are negative. We have to use price to sales.
With a $90 billion market cap and about $4.4 billion in annual revenue, they're trading at a premium 20 times sales.
A huge premium. Legacy tech is at 10 to 12, but then you see Palantir at over 25 and Databricks getting a similar multiple in the private market. The market is paying up because it believes in that 25 to 30% durable growth and the AI story.
To find the intrinsic value, we used a discounted cash flow model.
Right, projecting future cash flows and discounting them back to today's value. Our model rests on three key assumptions. First, growth. We assume 28% next year, gradually tapering down to 12% over 10 years.
Second, the discount rate. We use a WACC of 9.5%. That's based on the 10-year Treasury at 4.08% plus a 5% equity risk premium, which is appropriate for a high-growth stock like this.
And third, a conservative 3.5% terminal growth weight, assuming data processing remains a utility service.
And when you plug all that in, the model spits out a base case intrinsic value range
of $250 to $280 per share. That is the definitive finding of our quantitative work.
Which brings us right back to where we started. The current stock price of $265 is sitting smack in the middle of that fair value range. The market has this price very efficiently.
It does. Before we get into the risks and sentiment, let's take a quick moment.
Like and subscribe to Stock Analytics AI.
And if you find this level of detail essential for your investment process,
for $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives. We'll see you in a second.
Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion.
Okay, we're back.
Chapter 4, Market Sentiment.
So how is Wall Street feeling about this fairly valued stock?
I call it cautious bullishness. After the Q3 earnings beat, they're starting to buy into the AI pivot.
We saw a bunch of price target raises. RBC to 300, Goldman to 275, Citizens even went to 325.
The thinking there is that the worst of the cloud optimization headwinds are over. And the real driver for those high targets is the belief that Snowpark and Cortex are a legitimate path back to durable growth. They're valuing the company on 2027 AI revenue streams.
But the media narrative is still just dominated by the war with Databricks.
Constantly. That $100 billion private valuation for Databricks creates this little brother complex for Snowflake. They're always having to prove they're still the modern platform.
But there are positive counter-narratives. That AWS Marketplace milestone was huge.
$2 billion in lifetime sales through that channel alone. That is critical validation that their ecosystem strategy is working and driving real revenue.
Okay, let's check the technicals. Short interest is low.
Very low, around 3.8%. Investors are just not willing to get against an AI-focused growth stock, even at this valuation.
And the momentum looks strong.
It does. At 265, it's trading above its 50-day and 200-day moving averages. And more importantly, the charts just formed a golden cross, where the 50-day crosses above the 200-day. For technical traders, that's a classic signal of a long-term uptrend breakout.
Chapter 5. Ownership structure.
Right. Who's buying and who's selling? Institutional ownership is really high, 70 to 80%, which gives it stability.
But Q3 saw a really interesting rotation. You had specialized growth funds buying in big.
Big time. Fidelity up to their stake by almost 38%. Jennison added 13%. They are making that execution bet on Ramaswamy. They believe the growth has bottomed.
But on the other side, you have the generalist funds taking profits. AP Morgan cut their position by 10%.
It looks like the funds that rode the initial rebound are taking some risk off the table, while the specialists are doubling down on the AI thesis.
Insider activity, though, it raises a bit of a red flag for me.
It warrants caution. You saw significant selling from key executives late in the year. A co-founder, Benoit Dageville, sold over $6 million worth. The EVP of product sold almost $2.5 million.
And sure, these are scheduled 10b5-1 plans. They're not panic selling. But the lack of any insider buying at these levels is telling.
It is. It reinforces our valuation finding. Management seems to view the stock as fairly valued, not cheap. They're not using their own cash to buy more.
And total insider ownership is only about 4%, which is lower than a lot of founder-led competitors.
A little less alignment there, which ties back to that whole dilution issue we talked about. Chapter 6, Risk Assessment.
All right, let's stress test this thing. We'll use a SWOT analysis to break down the risks.
Let's start with the internal strengths. We've talked about data gravity. It's their stickiest asset.
Then multi-cloud neutrality. That's a huge differentiator, giving customers freedom the hyperscalers can't match.
And third, that SQL-first ease of use. It just lowers the barrier to entry for so many companies.
Okay, weaknesses, internal. Number one has to be cost perception, the bill shock.
Always. The consumption model can punish you with massive unexpected bills, and that creates constant friction with CFOs.
Second, the AI laggard perception. Databricks has just owned that narrative, forcing Snowflake to play catch-up.
And third, that financial drag of massive dilution from SBC. They have to keep running faster just to stand still on an earnings per share basis.
Now for opportunities. External. The biggest one seems to be turning the marketplace into a real AI app store.
Imagine that. Buying an inventory optimizer AI agent that just runs securely on your data with Snowflake taking a cut, that would blow their TAM wide open.
The other big opportunity is iceberg tables.
A crucial technical shift. By adopting the open iceberg format, Snowflake can now manage data that lives outside its own proprietary storage.
So they stop competing on where the data is stored and just focus on monetizing the compute needed to analyze it wherever it lives.
Exactly. It's an exponential expansion of their potential revenue pool.
Finally, the threats. External. Commoditization of compute is a constant worry.
If Redshift and BigQuery get good enough, but are way cheaper, that premium pricing gets harder to defend.
And you have the open source stacks. Tools like DuckDB and ClickHouse let smaller companies just roll their own solution.
Right. Now we have to talk about the immediate macro threats. First is interest rates. The 10-year is at 4.08%. High rates compress growth stock multiples. Simple as that.
Second, their model is just so vulnerable to IT budget cuts. When a CFO panics, cloud consumption is one of the first things they look at.
But the hidden risk, the one management specifically warned about, is the tariff shock of 2025.
This is a really important second-order risk.
It is. The U.S. imposed aggressive new tariffs. The direct impact on Snowflake is zero. They sell software, but the indirect impact on their core customers is immense.
You think about their client base. Global manufacturing, automotive, logistics, those are the companies getting hammered by this. Reports show exports from affected countries are crashing.
These are Snowflake's whales, the million-dollar-a-year customers. And when their margins get crushed by trade volatility, they stop spending on big new projects.
And the CEO, Ramaswamy, was explicit about this. He said that in this environment, CFOs are just not going to commit large dollars to new IT or AI projects.
So a prolonged trade war doesn't have to touch Snowflake directly to cripple its growth. It just freezes the very AI projects they're banking on. If that happens, growth could plummet from 29% down to 15%, and the stock would correct hard, probably toward that $200 level.
Chapter 7. Conclusion.
All right, let's bring it all together. The competing arguments that define Snowflake's valuation right now.
The bull case is simple. Snowflake is the iPhone of enterprise data. It's the secure, premium, integrated experience the Global 2000 demands for generative AI, and it's all backed by a fortress balance sheet and durable 29% growth.
The bear case sees them as a vulnerable cloud oracle. The valuation at 20 times sales leaves zero room for error. Databricks owns the AI narrative, and the company is highly exposed to macro shocks like those tariffs, which could cut their growth in half.
And our valuation summary restatement, based on the DCF, confirms the fair value range is $250 to $280 per share.
So our final assessment is that at $265, Snowflake is fairly valued. You are not buying a bargain here. You are paying a fair price for a premium asset. The margin of safety is thin to non-existent.
So buying here isn't a valuation play. It is purely an execution bet on CEO Sridhar Ramaswamy. You're betting he can successfully pivot the company into the AI operating system for the enterprise.
Which leads to our actionable summary. For existing owners, it's a hold. You own a great company that's fully priced. For new capital, we'd say watch. Wait for clearer evidence of AI revenue, or for a better entry point, maybe closer to that $200 support level, which gives you a healthier margin of safety.
And we'll leave you with the final provocative thought, building on that iceberg tables opportunity we talked about. What if Ramaswamy decides to just stop fighting the storage war? What if Snowflake fully leans into being the pure compute and governance engine for all data, no matter where it lives?
That would be a seismic shift. It would position them as the universal control plane for the entire intelligence economy. It would completely change the narrative with Databricks from a zero-sum battle to coexistence. And that is the kind of move that could justify a valuation well north of $300 a share.
A huge move indeed. Thank you for joining us for this deep dive into Snowflake.
We hope you feel thoroughly informed and ready to evaluate this challenging stock.
Like and subscribe to Stock Analytics AI.
And if you need access to detailed analyses like this across the entire market,
For $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
and a final reminder. This analysis was generated by an AI system using publicly available documents and should be treated as educational.
Please remember that this is for educational purposes only and should not be considered financial advice. You must always conduct your own research or consult with a qualified financial advisor before making any investment decisions.